Well, we're underweight non-U.S. equities.
Non-U.S.
We're still overweight U.S. equities.
Does this worry you?
It does. So we have pulled back from much more aggressive position we had earlier in the year to one that's a bit more balanced. So we're still underweight bonds, overweight cash, overweight the U.S., but underweight non-U.S. stocks.
Are we at the point, Bob, where we can back away from the economists' prediction of the impact on the economy? They do it very quantitatively, obviously, because that's what you can do. The impact of the tariffs specifically on that amount of goods. But we're at the point now where we're looking at retaliatory measures that aren't quantitative, that have much deeper impacts on a much broader swath of the U.S. economy.
That's what's worrying the market this morning, obviously. We don't know where this is going to go. And the uncertainty and the history in trade is just not good. And that's what has the market concerned. As Ed pointed out, thankfully, we have a massive tailwind. We're about to see it with second quarter earnings, and that will provide the other side of the coin. Trade's been off the front burner for the last few days, and the markets have drifted higher. Now it's on the front burner, and we struggle again. This tug of war that we've been in for months, I think, continues.
But the context of this pullback maybe is relevant too, right? We're up 3% in 4 days in the S&P 500. The news hit of this $200 billion in additional products in the 4 o'clock hour. Futures immediately go down and then kind of sit there. So it seems as if the market has seen enough times where we've had this reflex reaction that didn't really carry through.
Yeah, well said. And so trying to be dispassionate, the bull would say this is all noise. It's all a bargaining tool to kind of get them to come to the table on their knees, et cetera, et cetera. And the bears would say, when you start a trade war, you can't stop it. I lean toward the view that earnings matter more than anything else, and that's what's kept the market doing pretty well.
Well, I thought it was interesting the way they decided to do it after the market recovers.
Yes.
And China's not recovering, and the yuan is not recovering. And, you know, we do it in, like, we inflict some pain, and then, you know, we feel it here, but then we come. If you look at where we are, we've been in this trade war. We've been hurt. They've been hurt much worse.
Yeah, but doesn't that? I wonder though, Ed, if that tells you that it's a negative sum game, right? We're hurt less. They're hurt more. Everyone's hurt.
That's right.
So therefore, free trade is a positive sum game. Everyone helps.
In terms of just pure, maybe effect to economies, but what about the end game for intellectual property? What about the end game for?
Maybe, Ed, if there were
maybe
a
that's
process,
a positive. Maybe that's
if there were a process, if the market were confident that this actually is a process and not just aggression.
How do you know when you're in the middle of it?
I think even people who disagree with the president on almost everything else agree that the U.S. needs to take a tougher stance towards China and towards intellectual property and some of the things we talked about. So I think there is a sense that, to some degree, people may disagree about the tactics, but the need to take a tougher stance. And I think the market has actually been remarkably calm about all of this. The U.S. is still up about 4 or 5% on the year, so you're still getting a pretty good year at the midway point, despite all of the concerns about trade and what it means for global GDP.
I mean, the VIX is the lowest level yesterday since June, right? June 15th.
Very docile market. Very dull. People say, oh, there's volatility. The market's not volatile. It's very quiet. Yeah, it's more volatile than last year, but relative to history, it's still very
jumpy within this range.
Yes. Yes.
And in recent weeks, I mean, it seems like we've had sort of a rotation towards slightly a more defensive tilt in the market, a bid to consumer staples, bid to utilities, away from technology. Is that going to characterize, you think the markets are going to go higher from here? Is that going to be the second half story?
I think actually the second half story is going to be pretty broad. Because it's going to be compelled very simply by tremendous earnings growth, over 25% earnings, or over 20% earnings growth.
We haven't been compelled by earnings this year.
Well,
We've
but
been
I think
in a
we
trading
have.
range.
I think you're under the surface you have. So why are you up, about 5% midway through the year with all the concerns about global trade and so forth? It's because earnings are so strong. And valuations have come down, so stocks are not as expensive as they were at the beginning of the year. So I think there's still reason for optimism. We're going to have days like this where news comes out. And again, this is not a big deal. This is a less than 1% drop, just as the futures are right now. So the market has taken this trade with a great deal of aplomb so far.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.